the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares began the day trading in the green, as markets abroad mostly closed higher. So in early trade, the Straits Times Index was up 0.1% at 3,835 points. Nearly 30 million securities changed hands in the broader market. But let's take you through the closing numbers. We do see the STI closing further in the green, up 0.81% at the close. We're looking at 3,861 points. In terms of value turnover, that's 1.27 billion Sing dollars. Gainers outnumbered losers 325 versus 202. Top advances for today, we've got here SGX, DBS and UOB, and top decliners, we've got here GMHUSD, Procure and iFast. Now, in terms of counters to watch, we have ST Engineering, because ST Engineering announced that it secured 4.3 billion Sing dollars in new contracts in the fourth quarter of 2024. Now, elsewhere, from what to expect ahead of the much anticipated US non-farm payrolls report to how gold is set to register its sixth successive weekly gain, we've got more international headlines in focus. And joining me on a Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, how are you?
I'm very good. How are you?
Welcome back. And we were just saying that we used to chat on the show on Market View some 18 months ago, close to 2 years already, 1.5.
Yes, so I do miss you guys, and I do miss being on the call, so it's very good to be back.
Wow, time really flies, huh? And Ben, let's start with the Singapore stock market as usual. How did the STI fare today in relation to global stock movements, especially when it comes down to the biggest movers, say ST Engineering?
Sure. So as you mentioned just now, the SIAS Index closed up about 0.81%. You've got most of the component stocks showing a healthy advance. You have got the minority of the component stocks 13 down, and the rest were more or less flat. So the biggest movers today were a smattering of REITs, and SGX was the biggest mover, up about 10%, followed by ST Engineering, Singtel, and so forth. Globally, or rather regionally speaking, it was kind of a mixed bag. Some markets were up, some markets were down, more or less in line with the US as well as Europe. I think all eyes are on tonight's release of the US non-farm payrolls. That could let, nobody wants to enter into a big position entering into the weekend on the Asian side, considering the big report coming out this evening. So we could see some, market movements in terms of the futures and options derivatives before the Singapore market opens on Monday. Now, you asked about ST Engineering. So really stellar performance today, trading volume of 10.2 million shares. And I really had to check this like a couple of times, which is 2.8 times its 15-day average volume of 3.6 million shares.
Wow.
And the stock price actually reached an all-time historical high of $5.05 this afternoon, but there was a little bit of profit taking at the end, so closed off. Official closing price was at $5, which is still a very amazing, very healthy 4% up compared to yesterday's close. So obviously the market loves the news, and considering ST Engineering is seen as one of those stewards of the old economies, slow moving, dependable, so on and so forth. Market really loved the news. From a technical perspective, this is actually a price breakout supported by strong volumes. So really bodes well for the future up moves next week. All things being equal, if let's say Donald Trump doesn't say something funny, I think this stock is going to run next week.
Okay.
Already we can see the research analysts from local houses, expecting ST Engineering post a very strong second half earnings.
Okay, and you talk about Donald Trump. I mean, we are seeing tariffs, we are seeing ban on parcels, then U-turns. So I suppose more twists and turns down the road. But zooming in on the other counters to watch on the SGX ban, let's take a pause, have a cup or a can of soda, because we're going to look at Fraser and Neave. The beverage maker today reported net profit of 52 million Sing dollars for first quarter. Its first quarter ended December, which is an 18.8% increase from what's seen in the same period the year before. How would you read into the latest numbers?
Well, I dug into the the investor relations material that they put up. Looking at financial broad picture, profit before interest and tax was up measly 1% in Singapore, but it surged 35% and 46% in Malaysia and Thailand, respectively, really on the back of better sales mix and a more favorable cost environment. So it looks as though they've got better handle on their supply chain costs. Myanmar market for them was stellar, no slouch. Beer sales more than doubled because of his Tapper beer brand. I've never tried it personally. There was also some uplift from early sell-in ahead of the Chinese New Year holiday, because suppliers were stocking up on the soft drinks. From the material they put up, they have come up with a new product line in terms of packaging for the Chinese New Year, as well as a zero calorie, zero sugar. I think it's food drink or something. Looks interesting. So I think the company is in a very good place with this set of numbers, and I really like the company's growth trajectory in Singapore's northern neighbours. So something to watch. Again, just like ST Engineering, not particularly exciting, but slow and steady.
And from F&N, let's take a look at this company that we always look at on the SGX, Singtel, because Singtel's regional data center arm called Nexera, DCT, it has secured a 643 million Sing dollars 5-year green loan to finance the development of a 58-megawatt data center right here in Singapore. How significant is the move for Singtel if we look at investors' reactions today?
Well, today's reaction specifically to this piece of news, I say, would be a bit muted. So on the whole, Singtel was up about 5%, around 5 cents, which represents a 1.5% advance. The trading volume was about the same as its 12-day moving average. So I wouldn't say this is a proper price breakout supported by volume, but is, as they say in French, okay lah. On the fundamental side of things, Singtel did say that they are part of NVIDIA's Partner Network Cloud program, and NVIDIA separately has in recent days disclosed that 20% of its revenue actually comes from products shipped to Singapore. Not built to, but shipped to, which means that the AI chips and servers are, more or less in data centers in Singapore. So if you look at the big picture, right, the availability of funding is really a net positive for Singtel, largely supports Singapore's national AI strategy by, building out the country's compute infrastructure. So although today's price action wasn't too exciting, but I think this is, very in line with their stated strategy, and I think this is all good in the long run.
Now, across the region, Ben, let's talk food. The consortium that's proposing to take 7&I Holdings private, it has reportedly tapped Citigroup and the Bank of America for financing. Now, Thai conglomerate CP All, which holds the Thai franchise for 7-Eleven, it is also reportedly weighing plans to take an equity stake in the management buyout, and that is of about 500 billion yen. All in, how would you read into that situation? What does a privatization mean for investors?
Okay, so I guess, for people who have not been looking at this, the current privatization plan was actually kicked off by the takeover attempt by a Canadian retailer called Alimentation. That was last year. They actually put in 2 public bids and 1 undisclosed bid. 7&I did not accept any of the bids last year, but I think it kind of spooked them into realizing that a hostile takeover of a Japanese company could actually be possible. Now, for the longest time, this was a no-no, as in, you have got the regulations, you've got the government rules and the exchange rules and all that. So it was very hard for a foreign player to actually buy out a Japanese company. But over the last decade or so, the government and regulators have, worked very hard to liberalize the Japanese stock market, and, a lot more focus on corporate governance, shareholder rights, shareholder returns, letting market forces call out poorly performing companies. And, that's why last year we had this huge run-up in the Japanese stock market. So this is just market forces at play here. So you have got the market perceives a company that is undervalued, well-run, undervalued, good franchise, but maybe current management is not squeezing out everything for shareholders. Therefore, a foreign competitor is swooping in to try and buy it. I think this is probably a net positive in the long run for investors as well as consumers, people who actually buy products. And there is a precedent for this in the US, right? So if you remember Dell Computers long time ago, it wasn't doing so well. It was taken private in a management buyout similar to what we're having now with 7&I by its founder, Michael Dell. And after a couple of years of restructuring, it was relisted and, it used the time to change its business model, pricing strategy, products and services, and stronger for it. So it's, all and good that this might be happening in 7&I, and we'll need to see what happens in a couple of months.
And we'll see what happens to the product mix at the stores. But if you're just tuning in, we're now in conversation with Benjamin Goh, Head of Research at SIAS. Now, further away, Ben, let's talk about ride-hailing platform Lyft in the U.S. It has tied up with Amazon and Alphabet-backed AI startup Anthropic to roll out AI tools for its customer care operations. Now, question over here, though, not exactly directly related, but how far does the collaboration set the stage for AI-enabled ride-hailing services? Could this bump up expectations of more use of AI in ride-hailing services like autonomous driving? Because Uber, for one thing, was hit by the debate over rising competition from autonomous vehicle makers in the longer term. So any thoughts on that?
Yeah, I think it's, I guess my view is that autonomous driving is kind of the holy grail for ride-hailing services.
Yeah.
Because if you look at the business model, a huge chunk of the, I wouldn't say cost, but the profit sharing actually goes to the drivers, human drivers of the assets, the cars, right? So if you were to remove the human drivers, then, of course, the ride-hailing services don't have to split the revenue for them, and that's, ka-ching profit in the bank, money in the bank, right? So it really makes sense for ride-hailing services to move towards autonomous driving, and as well as leveraging AI to run ancillary services, such as the aforementioned customer care operations, right? So it's very scalable. If the algos and the model gets to a place where people will actually like to talk to them and doesn't feel weird, and they implement this, it's going to save them a lot of costs. And of course, if you look at Lyft, they are a ride-hailing service, but they don't actually have the technology. So if companies like them are unable to develop the capability in-house, it really makes a lot of sense for them to partner with companies that are already working on technology, right? So if you look at Amazon is a key player in the AI compute infrastructure, Amazon Web Services, and you have got Alphabet, Google. So it's a global leader in AI machine learning models, always competing with OpenAI and nowadays DeepSeek. So they are leaders in that field. So this kind of combination really makes sense. If you look at the comparative factors here, ride-hailing companies like Uber, Lyft, Grab, so on and so forth, they are not direct competitors with autonomous vehicle makers such as Tesla, and some of the European brands are also doing this as well. But if you think about it in the future, I think these separate industries are probably going to overlap more and more because once the autonomous vehicle technology is perfected, there's really nothing stopping Tesla from starting its own ride-hailing platform. I mean, Elon Musk wants to put people on Mars, right? I mean, space shuttles and rockets. I mean, what's a car to him, right? So next time you buy a Tesla car, you can, you drive to the office, and then the car goes out and picks up passengers on your behalf, and you get a cut
passive
of the
income.
Revenue at the end of the day, ka-ching, right? So that's all good. And so if you look at the disruption that AI brings, right, especially in this sector, I think it is smart for the other players to follow this direction and start partnering with the AI companies sooner rather than later. Because if you're the last man, when the music stops, it's going to be very, very tough.
And before we move on, since we talked about Amazon, I do want to mention this in brief because in extended trade, we saw shares of Amazon tumbling 4% because even though the firm reported beats on the, I think, top and bottom lines, revenue and earnings, its guidance was weak. It disappointed investors. It called for revenue growth of 5% to 9%, which is the weakest on record. But conversation for another day. Ben, in the meantime, let's take a look at gold prices. They steadied near record highs earlier and were headed to lock their sixth successive weekly gain. Trade wars jitters lifting that safe haven demand, but what are the levels to watch?
Well, just today in the afternoon, Citigroup just upgraded its 3-month price target for gold from $2,800 per ounce to $3,000 per ounce. So trade war jitters are definitely a driving force. Another factor I'll look at will be the central banks from emerging economies like Vietnam, Thailand, Indonesia, so on and so forth. They are also building up the gold reserves, to support their own currencies in the event that geopolitical tensions or market forces put pressure on their currencies. So they are building a buffer. There is also a short-term supply issue right now, because of what Donald Trump is doing. Some traders are actually moving their gold deposits from the Bank of England in the UK to New York's COMEX exchange. So the challenge here is really operational because the gold is actually traded in 400-ounce bars in London, but in New York it's traded in 100-ounce bars, right? So it's not just about the price of the gold, but the gold product, the physical product itself is different. So currently there is a kind of a mini rush for the 100-ounce gold bars in the U.S., therefore it's pushing up demand in that area. But of course, you think about it, 400-ounce gold bars can be refined into 100-ounce gold bars, right? So this demand-supply mismatch is probably going to ease over time. Based on the current research, the average gold price may settle at or slightly below $3,000 per ounce this year. But we have to see what Trump 2.0 brings. So further volatility may push gold past that level.
Okay. And finally, before we let you go, Benjamin, I've got about 1.5 minutes. All eyes on the U.S. non-farm payroll numbers for January. Analysts projecting an increase of 169,000 jobs for the month. Unemployment rate remaining flat at 4.1%. What are you expecting? What are the implications for the Fed?
Sure. So I'm cautiously optimistic that the initial print will be higher than the 169K that you mentioned just now. This is based off the analysis of high-frequency data by Bloomberg. So it may actually come in north of 200K, which will be, good. But the other main thing that's happening is that the Bureau of Labor Statistics in the U.S. is actually updating its model. So we are all expecting it to revise its 2024 employment numbers lower actually by about 800K. So that suggests that the U.S. government has got a lot more to do to stabilize the U.S. unemployment rate, which is currently at 4.1. So that's not great. And that really is going to put the Fed in a tough position, right? Because the Fed needs to keep interest rates elevated to fight inflation. But in order to reduce unemployment, it needs to lower interest rates. And then you throw in the brewing trade wars and geopolitical tensions. I'm so glad I'm not Fed chairperson Jerome Powell. I'm sitting here in Singapore.
Yeah, I see. Lots to watch indeed. We'll see what happens tonight. Hopefully it doesn't throw us off so we can enjoy our weekend. Thanks so much, Ben. As usual, that was Benjamin Goh, Head of Research at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.